What if the biggest risk in investing is not the market, but your own emotions? Most people think investing is about predicting the future, finding the next hot stock, or reacting quickly to news. But this book begins by quietly turning that idea upside down. It argues that the real path to wealth is not excitement, but discipline, not speed, but patience. And before we go further, if you want to grow wiser and stronger with every book, subscribe to the Book Day and become better than yesterday. The Intelligent Investor was written by Benjamin Graham, a man often called the father of value investing. He lived through some of the worst financial disasters in history, including the Great Depression. He saw fortunes rise and collapse, not because of logic, but because of fear and greed. From those experiences, he built a simple but powerful philosophy. Successful investing is more about behavior than brilliance. Graham makes a clear distinction right at the start. He separates investing from speculation. Speculation is trying to guess what others will pay tomorrow. Investing is carefully buying something for less than what it is truly worth. One is driven by emotion and crowd psychology. The other is guided by analysis and patience. He warns that most people believe they are investing when they are actually speculating. They chase trends. They buy what is rising and panic when it falls. Their decisions change with headlines and rumors. Graham argues that this constant reacting is the main reason people lose money. According to him, an intelligent investor does not try to outsmart everyone else. Instead, they build rules and stick to them. They accept that markets move up and down unpredictably. Instead of fighting that chaos, they prepare for it. One of the most important ideas introduced early in the book is that the market is there to serve you, not guide you. Prices change every day, but value changes slowly. If you confuse price with value, you will be controlled by the market's mood swings. If you understand the difference, you can use those swings to your advantage. Graham encourages readers to see the market as a strange business partner who offers to buy or sell every day at different prices. Some days the offer is ridiculous. Some days it is attractive. The intelligent investor doesn't feel forced to respond every time. They wait for the days when the offer makes sense. This mindset requires emotional control. Most people feel the urge to act constantly. Graham teaches the opposite. Activity is not the same as progress. Often, the smartest move is to do nothing and simply hold quality investments patiently. The foundation of this book is simple but demanding. Protect yourself from big mistakes, and steady gains will follow. Intelligence in investing is not about predicting the future. It is about preparing for uncertainty. Benjamin Graham explains market behavior using one of the most memorable characters in finance, an imaginary partner he calls Mr. Market. Imagine you own a small business with a partner. Every single day, this partner comes to you and offers to either buy your share of the business or sell you his share. The strange part is his mood changes constantly. Some days he is wildly optimistic and names a very high price. Other days he is depressed and offers a very low one. You are never forced to accept his offer. You can ignore him completely, but he will return tomorrow with a new price. This, Graham says, is exactly how the stock market behaves. The problem is that most people treat Mr. Market as a guide instead of an opportunity. When prices rise, they feel confident and rush to buy because everyone else is buying. When prices fall, they panic and sell because everyone else is afraid. They let Mr. Market's mood control their decisions. The intelligent investor does the opposite. When Mr. Market is overly excited and prices are too high, the intelligent investor becomes cautious. When Mr. Market is fearful and prices are low, the intelligent investor becomes interested. Instead of following the crowd, they quietly take advantage of it. This idea changes everything because it removes pressure. You are not required to trade every day. You are not required to react to every price change. The market's job is only to offer prices. Your job is to decide whether those prices are reasonable. Graham warns that emotional reactions to price swings are the main enemy of investors. Fear makes people sell valuable assets cheaply. Greed makes them buy overpriced ones. Both reactions come from treating market prices as truth instead of opinion. Price is what people are willing to pay right now. Value is what something is actually worth over time. These two are often very different. Mr. Market's daily offers are just opinions. Some opinions are useful, many are not. The intelligent investor learns to ignore the noise and focus on real worth. This approach requires patience. There will be long periods where the best action is to wait. Waiting feels uncomfortable because it looks inactive, but Graham insists that discipline beats constant movement. Wealth grows from good decisions held over time, not from endless buying and selling. He also makes an important emotional point. Market declines are not disasters for the intelligent investor. They are opportunities. Falling prices mean quality assets can be bought more cheaply. Only those who panic see drops as danger. Those who stay calm see them as discounts. By viewing the market as an emotional partner rather than an all-knowing authority, you gain independence. You stop being pushed around by headlines and trends. You start choosing based on logic and value. This mental shift is the first real protection against costly mistakes. At the heart of Benjamin Graham's philosophy is one powerful idea that acts like a shield against disaster: the margin of safety. The margin of safety means you never buy an investment at its full estimated value. You buy it at a significant discount. That discount is your protection against mistakes, bad luck, and unpredictable events. Graham understood something simple but humbling. No one can calculate value perfectly. Even the smartest investor can be wrong. Markets can fall. Businesses can struggle. The future can surprise you. The margin of safety exists to protect you when your assumptions fail. Imagine a bridge built to hold 10,000 kilograms. Intelligent engineers will not drive trucks weighing exactly 10,000 kilograms across it. They will limit the load to something much lower, maybe 7,000. That extra strength is what keeps the bridge standing when unexpected pressure appears. Investing works the same way. If careful analysis suggests a company is worth 100, the intelligent investor does not pay 100. They might pay 70 or even less. That gap is the safety margin. If the estimate was slightly wrong, or if temporary problems arise, the investment still has room to survive. Without that margin, even small errors become costly. With it, mistakes become manageable. Most people do the opposite. They buy when excitement pushes prices above real value. They pay 120 for something worth 100 because they expect it to rise further. That is speculation. It leaves no protection. If anything goes wrong, losses come quickly. Graham's rule is strict because markets are unpredictable. Even strong companies face difficult years. A margin of safety turns volatility from a threat into an opportunity. When prices fall, you are still protected instead of exposed. This idea also reduces emotional stress. Investors without a safety cushion feel fear during every downturn. Those with protection can stay calm because their risk was controlled from the start. Graham emphasizes that the margin of safety is not about finding perfect businesses. It is about buying wisely. You do not need to be right all the time. You only need to avoid being badly wrong. Small wins held safely grow into large gains over time. The margin of safety also creates patience. When you know you bought at a discount, you are less tempted to sell during temporary drops. You can wait for value to be recognized instead of reacting to short-term noise. In simple terms, you are not chasing profits. You are first preventing losses, and by preventing large losses, long-term wealth becomes possible. This principle separates intelligent investing from gambling. Gambling relies on hope. Intelligent investing relies on protection. After explaining how to think about the market and how to protect yourself with a margin of safety, Benjamin Graham introduces an important truth. Not all investors should use the same strategy. He divides investors into two types: not rich and poor, not smart and average, but defensive and enterprising. The defensive investor is someone who wants solid results with minimal time, effort, and stress. This person does not want to study financial statements every night or track market movements every hour. They want a reliable, disciplined approach that protects their money and grows it steadily. For this type of investor, Graham recommends simplicity and balance. Instead of trying to pick winning stocks, the defensive investor should spread money across strong, established companies and high-quality bonds. This mix reduces risk because when stocks fall, bonds often hold steady, and when bonds return little, stocks can grow. Graham suggests keeping a fixed ratio between the two, often around half in stocks and half in bonds, adjusting only when prices move to extremes. This rule forces you to buy more stocks when they become cheap and reduce them when they become expensive. In other words, it quietly turns market mood swings into disciplined decisions. The defensive path is powerful because it avoids the biggest enemy of wealth, overconfidence. By accepting average but dependable returns, this investor avoids reckless risks and emotional mistakes. The enterprising investor, on the other hand, is willing to work harder. This person studies companies deeply, searches for overlooked opportunities, and is ready to act when prices fall far below true value. The enterprising investor is not chasing trends. They are searching for bargains others ignore. But Graham gives a warning. Extra effort only makes sense if it is done with strict discipline. Active investing without patience becomes speculation. The enterprising investor must be prepared to look wrong for long periods while waiting for value to be recognized. This path requires emotional strength. When others panic, you must analyze calmly. When others celebrate, you must remain cautious. The reward for this effort can be higher returns, but only if rules are followed consistently. The most important lesson here is that success does not depend on choosing the more exciting path. It depends on choosing the path that matches your temperament. A defensive investor who sticks to a simple plan will outperform an enterprising investor who constantly changes strategies. Consistency beats complexity. Graham's wisdom is practical. If you cannot commit time and discipline to deep research, stay defensive and steady. If you enjoy analysis and can remain patient under pressure, you may choose the enterprising route. Both paths work, both require self-control. The difference is not intelligence, it is effort and emotional stability. Benjamin Graham repeatedly returns to one uncomfortable truth. The biggest threat to your investment success is not the economy, not inflation, and not even market crashes. It is your own behavior. Most losses do not come from bad businesses alone. They come from bad reactions. When markets rise quickly, people feel confident and take bigger risks than they normally would. They borrow money, chase popular stocks, and convince themselves that this time is different. When markets fall, those same people panic. They sell quality investments at the worst possible moment just to feel safe again. This cycle repeats across generations because emotions repeat across generations. Graham explains that intelligent investing is not about predicting what the market will do next year. It is about preparing yourself so that whatever happens next year does not break you. The future will always be uncertain. The only controllable factor is how you respond. This is why rules matter more than opinions. If you decide in advance how much risk you will take, how you will spread your money, and when you will buy or sell, you remove emotion from the decision. Without rules, every market movement feels urgent. With rules, movements become routine. Graham warns strongly against listening too closely to forecasts. Experts disagree constantly. Predictions change with every headline. Acting on predictions turns investing into guessing. Guessing leads to stress, and stress leads to mistakes. The intelligent investor focuses on what can be measured, not what can be imagined. Company earnings, financial strength, long-term value, not rumors or excitement. Another critical behavior is resisting the urge to constantly act. Activity feels productive, but frequent trading increases costs and increases the chance of emotional errors. Often, the best investment action is patience. Graham also highlights the danger of comparing yourself to others. When friends boast about quick gains, pressure builds. Many investors abandon their plans simply to keep up. This comparison pulls them into speculation instead of disciplined investing. True success in investing is quiet and often boring. It grows slowly and steadily. It does not need constant excitement to survive. The intelligent investor learns to welcome market declines instead of fearing them. Lower prices mean future returns become higher for patient buyers. Downturns are temporary. Discipline is permanent. By mastering your reactions, you turn volatility into an ally instead of an enemy. The market may swing wildly, but your behavior stays steady. As we reach the end of this journey, Benjamin Graham's message becomes clear and almost calming. Successful investing is not about finding a secret formula. It is about building habits that protect you from your own impulses. You do not need to predict the next boom. You do not need to chase the next hot stock. You do not need to react to every headline. What you need is a simple, rational framework and the discipline to follow it for years. Graham's philosophy stands on three strong pillars. First, understand the difference between price and value. The market will constantly shout prices at you, changing every day, but value moves slowly based on real business performance. When you stop confusing the two, market chaos stops controlling your emotions. Second, demand a margin of safety. Never rely on perfect predictions. Always leave room for error. This cushion turns uncertainty from a threat into something you can survive and even benefit from. Third, control your behavior. Markets will tempt you with greed and scare you with fear. If you react to both, you will always buy high and sell low. If you stay calm and stick to your rules, you will quietly build wealth while others exhaust themselves. Graham also reminds us that investing is not a competition against other people. It is a long conversation with time. Those who try to win every short-term battle often lose the war. Those who focus on steady progress eventually reach financial independence. There will be years of excitement and years of disappointment. Intelligent investors accept both as normal. They do not expect smooth growth. They expect cycles, and they prepare for them in advance. This mindset removes urgency. You no longer feel forced to act every day. You wait for opportunity instead of chasing it. You measure success in decades, not weeks. The most powerful idea in the book is surprisingly simple. To become a successful investor, you do not need a high IQ. You need emotional balance, the ability to think independently when others panic, the patience to hold when others rush, the humility to admit you can be wrong and protect yourself accordingly. In the end, the intelligent investor is not the most brilliant or the most daring. The intelligent investor is the most disciplined. They let Mr. Market offer prices but never control decisions. They buy with protection, not hope. They act with patience, not excitement. And over time, that quiet discipline turns uncertainty into opportunity and ordinary savings into lasting wealth. That is the real lesson.